Okay, let's get a little bit more on what's happening in the markets this morning. Alan Nuckman is the chief market strategist at Agora Financial. He's in Chicago. Alan, we've got a sell-off on our hands. What's the primary factor for the stock pressure this morning?
Well, first off, the markets can't go up every day, even though in the last couple of weeks it may seem that way. So you're seeing a little bit of profit-taking pullback. The excuse that we're seeing right now is obviously rising rates. Rates have to rise, and in my opinion, that's a healthy sign that the economy is doing well, and we have the strength for rates to go higher. The number that I'm focused on, now that we're solidly above 3% in the 10-year note yield, is let's talk about 4%. 4% is a big number. Now, this last swing move, if we go back to 2000 when rates are at 6.5%, went down to 1.5% here recently in 2016, the midpoint of that move is 4%. So we're still significantly below that. Yes, we bounced off the bottom, but we still have very, very low rates.
Well, one of the things, we talked about this earlier today, the bond market basically played the role of psych out for the stock market earlier this year when people were starting to freak out about 3%, and then we saw some big pressure on stocks, only to see people pile back in. So what do you think is the, I mean, I get it, a little bit of selling pressure in stocks based on higher interest rates, but we got earnings season coming up as well, and I haven't seen a lot of high-profile strategists change their tune longer term. So what is that factor that really changes the game, makes people say, okay, stock market's not for me anymore?
Well, I think the question you're asking is when people are going to shift from being primarily in the equity market to getting back into the treasuries, getting back into fixed income where they're getting a conservative yield. Right now, there's still not any choice. If you look at the short-term money, yeah, we're at 2%. But, looking at the payoffs that we've seen in the stock markets over the last couple of years and the continued earnings growth, we're looking at another quarter of 20% earnings growth. That'll be 3 quarters in a row. So, the PE ratio, if earnings continue to expand, obviously prices need to keep track. So I don't see that changing anytime soon. At some point, long-term, if you look at the long-term average for interest rates is about 4.5%. So we're still a long ways away from that. At some point, that'll be an equation that people will have to factor in that choice. But right now, there still is no choice. And I think people are comfortable with going into the stock market to get returns because it's been happening consistently now for 8 going on 9 years.
Yeah. Well, I was talking with Andrew McCreath earlier about this next possibility, but let's say that all of a sudden, as interest rates continue to climb, let's say the sentiment changes and investors start to sell stocks. What role does the president play in that? I mean, he's shown a full willingness to weigh in on interest rate policy, and certainly with some of the news about a strong economy this week, I mean, he's been tweeting about that again.
Right. Well, I thought I was going to get a break going on Canadian television that I wouldn't have to talk about politics or policy, but you got me on this one. When it comes to the president, I'm a price guy. The president's going to say and do what he does, and if you look at it, has limited market reaction. You usually get a short-term reaction to what he says, some sort of surprise or something that doesn't make sense economically. The markets sell the rumor and then they buy the fact. Every time he said something surprising, it's hurt in the short term, but in the longer term, people shake it off. So there's a 48-hour rule that I like to use for myself to see where we are after 48 hours after something is stupidly said that doesn't make sense, and see where we stand. The markets are still strong. Yeah, he's talking his book. He's a real estate guy. He doesn't want rates to go higher, and he's all focused on his primary source of revenue and income. He's not focusing on the country. The Fed in itself obviously is supposed to be independent, and if you look at the Fed's actions, we're going to raise rates again in December. The September was a 100% chance that there were a probability they're going to raise rates. I don't think I've ever seen 100% before. And nothing's 100%, but it was. And then so we're going to raise rates in December, and then it looks like March and then June. And then after that, there's no more rate hikes scheduled. So what's interesting here is that, yes, we're seeing the futures markets move higher in the 10-year and the 30-year, but those are not directly impacted by the Fed. The Fed can only impact short-term rates. And another factor that I want to point out is even though rates are climbing to the highest point that we've been in a couple of years in the 10-year note, The dollar index right now is still about 100 ticks away from its top that we saw in August. So the dollar's not strengthening as much as it would if this was going to be a continued policy here for the future.
Okay, and before you go, just a quick thought on oil. We talk about it every day here, the fact that oil prices, I mean, they're down a little bit today, but they're around 4-year highs. But there's, for example, a discount for crude in Canada. Energy stocks, at the end of the day, have lagged the rest of the market. I think you could say the same thing about energy stocks in the United States.
Exactly. Yeah, and I see that as an opportunity. I think that's the next stock market catalyst, that these energy stocks start to play ball and rally. And we've finally seen that in some of the big boys. We've finally seen Exxon, break out and rally, and Chevron make a bottom base. And that's been big as far as our stock indexes go. But I think that's an untapped area of opportunity looking at that. And I, again, like I said earlier, said higher interest rates are a sign of health here in the market. And I say the same thing about crude oil. I use crude oil as a barometer. So you're seeing crude oil prices rise, and we all know the supply situation in North America. Okay, that's been beaten to death. But what we don't talk about is the global growth story that's stopping all that up, and that demand is got the prices up to these high 4-year levels. So I look at that as a positive as well, and I think that's going to carry the stock market a next leg higher. I'm talking 30,000 in the Dow. You take that 3,300 point sell-off that we had, add it to those old highs. 30,000 in the Dow is not that far away.
All right. Well, interesting numbers to watch for. Alan, thanks as always. Alan Nuckman, Chief Market Strategist at Agora Financial.